Welcome to Investors Insights. Our topic today, rates, rates, rates. People continue to ask us about interest rates, and we're here today to talk about that in relation to market volatility, debt ceiling, technical analysis that we follow here at Five Plan Partners. I'm joined by my distinguished colleagues, and I call them that with respect, Bobby Norman, Trey Booth, and Ty Miller. I thoroughly enjoy our Monday meetings, the debate, the dialogues. A couple of weeks ago in our vlogs, we talked about that rates may go higher after the Fed cut rates. And we're going to elaborate on that today. And I'm excited to continue that discussion. And hopefully it will answer some questions for each of you watching this vlog. So let's start off, Bobby. Really enjoyed what you said in our meeting today. It was in relation to market volatility as well as seasonality. Talk to us about that and interest rates.
Yeah, so the broader market wrapped up December with a 2.5% loss. And as you can see in this chart, coming in well below its historical average return of 1.4% in December that you can see in the far right column. The good news is that from a seasonality perspective, January has historically been a positive month that you can see in the first column there on the left. Unfortunately, the market has been under pressure to start 2025 due to uncertainty around if the Fed's going to continue to cut rates. And we've seen the 10-year yield rise to a 14-month high and a level that historically creates additional volatility. So you can see in this next chart that yields rose at the end of the year, which hurt the market performance and continues to be a concern and cause volatility in the new year. In fact, looking at where rates have come up from, you can see in this next chart that the 10-year yield was at 4% just 3 months ago. And as of close on Friday, yields have spiked to over 4.7%. That's a big jump in a 3-month period. This matters because stocks have come under pressure when 10-year yields rise to above 4.5%. So we could continue to see the broader market under pressure until we see rates stabilize. So the market will be fighting higher rates in a month that historically is positive. So we'll keep our viewers updated on the impact that higher rates are having on not only the stock market, but the bond market as well.
Great insight there, Bobby. Thank you. Well done. It helps people understand what we're going through. But then, Trey, you also interjected some phenomenal points about the debt ceiling, government debt. And that's been a topic with our clients as well. Tie that into what Bobby just shared with us.
Yeah, thanks, Greg. And to your point, I want to go back to, we've been talking about how the Fed has had the opposite effect on interest rates for months now. And I'll show you this chart real quick. It shows the Fed interest rates versus mortgage rates. And as Fed rates came down, you're seeing mortgage rates go up. And one of the things the market has taken into account that Bobby was talking about is that the Fed may pause. And we've been talking about this for a while as well. We'd like the Fed to stop. You can see, please stop trying to help us, because every time the Fed cuts rates, it pushes rates higher. Something else, though, that's on the calendar, besides we believe a Fed pause, we don't think the Fed will cut rates or hike rates. They're hopefully going to stop trying to help the market for a while. But also is the debt ceiling. That was on the calendar as the new year turned. The U.S. government hit what's called the debt ceiling, and that sounds like a scary event. But what it is that means that the government cannot issue any net new debt. So the total amount of debt is capped. They're still borrowing at the same rate they were before, and so what happens when the government spends money is they typically take either from borrowed funds or taxing Peter to pay Paul, and so it's a net wash with the government in between, taking from borrowing or taxing. They're still taxing. And they're still re-upping the borrowing they've already done. They just can no longer increase the amount of borrowing. So they're not issuing any net new debt. And so that traditionally has been a good thing for bond interest rates, because like all prices, they're set by supply and demand. And so the federal government, the largest issuer of debt in the world, is no longer issuing net new debt. And so that lack of supply should put downward pressure on interest rates. So we may have seen the peak in the cycle. And Strategics, again, our research partners, have a good chart here showing the amount of liquidity. What that is the amount of money that the federal government is paying out in above and beyond what they're expected to tax, and because they can no longer borrow. And we're expecting around $300 billion of net outlays in the first quarter of 2025. That, again, should be net positive for risk assets, put downward pressure on interest rates, which should put upward pressure on stock prices. So we should have a little bit of leeway. You can see there in April, once people pay their tax bills, that liquidity comes back out, and then it goes back in May. But for the first quarter, we should be a nice little sweet spot where we may have seen the highs for this cycle in interest rates. And hopefully the Fed will sit on the sidelines and stop trying to help us.
We can only hope, Trey. Thank you. That was well done. Folks, you've heard some great explanations here in terms of rates, market volatility, government debt. And then also one thing that we like to talk about here at Five Plan Partners, and probably don't elaborate enough in our vlogs on it, is we use fundamental analysis as we look at the markets, but we also use technical analysis. And technical, the two together, we believe is crucial as we navigate through market cycles and volatility. Ty, you took the information that Bobby and Trey presented and just used technical analysis to elaborate on some things of what we're looking for. So talk to our audience about that.
Yeah, so there's 3 indicators we're looking at right now. They're called the January trifecta. And so the first indicator is the Santa Claus rally, and that's from Christmas to the first 2 trading days in January. That was down. Santa Claus, we did not rally this year. He didn't come to town. We did not have that, which can be seen as a negative. However, it's probably the least important of the 3 indicators. The next indicator we're looking at is the first 5 days indicator. And so that takes into account the market performance in the first 5 trading days of the year. That was actually up across most of these indices. In the last 48 times that it has been up, we've seen a full year gain 40 times. So that's about an 83% accuracy rate, just technically speaking. Again, it doesn't, of course, not 100%. That doesn't have to mean that that's what's going to happen this year. But the first 5 trading days was a good indicator for us. So we have one, negative one positive one. And so the third one, the most important of all, is the January barometer. There's a famous saying that says, as January goes, so goes the rest of the year. And as you see in this chart here, December, while, as Bobby alluded to, is seen as typically a good month. We usually see good performance. It was down this year. However, when December's positive, the market 6 months from then is typically up 3.6%. When December's negative, it's actually up 6.1%. So almost double a return when December's actually negative, even though it doesn't happen often. However, when January is negative, 6 months later, you only see 0.6% of a return. So basically flat if January is negative. But when January is positive, 6 months later, you're typically up 7%, historically speaking. So December, again, even though it was negative, and that can be seen as a negative, of course, January seems to be much more important for its performance, and that's something that we're going to track as we're, about halfway through the month here.
Yeah, there's no doubt. January is a very important month, and I thought you did a great summary there. So, well, hopefully, folks, you've gained a lot of knowledge from this vlog. And at Five Plan Partners, we believe that it's knowledge that gives you strength as well as helps eliminate anxieties to move forward. You've gotten a lot of positive information from this vlog and insight. And we want to continue that not only in the month of January, but throughout the year. To fully utilize what we're doing here at Five Plan Partners, we like to have those one-on-one conversations, those email communications, blogs and Zoom meetings like this, as well, one-on-one. However, we can talk to you, relate things to you. If you have questions, a lot of you are great to send us topics for our vlog, and we want you to keep doing that. And then the other thing I would ask of you is that if you forward this vlog to others, please do. We like to provide information. We're frustrated educators. And the same applies to our social media on LinkedIn, Twitter, Facebook, YouTube, on our podcast. Information, knowledge. We want you to have as much as you can receive and utilize so that you can be confident each and every day, knowing we're providing that information and navigating these markets to see to it that our clients have a better, richer, fuller life. We thank you for 2024, and we are thrilled as we move forward in this year of 2025. It's not going to be dull, and we're looking forward to communicating with you. Have a great week.